China just signaled that Washington might reverse a 5-year-old trade penalty on Hong Kong. No headlines about missiles this time. No oil price charts. Just two governments quietly testing whether they can be friendlier again. But don't let the quiet fool you. Because if this actually goes through, it could reshape how global businesses treat Hong Kong as a financial hub for the first time since 2020. Let's break down what just happened, and what it means for the wider economy. No sides taken. Here's the timeline. On Friday, China's Commerce Ministry announced that the United States has confirmed it will not renew an executive order that stripped Hong Kong of its special trading status. That order was originally signed back in 2020 during Trump's first term, after Beijing imposed a national security law on Hong Kong. At the time, Washington argued Hong Kong was no longer autonomous enough from mainland China to deserve separate treatment on trade. The order has been renewed every year since, most recently just last July. Now, for the first time, the U.S. appears ready to simply let it expire instead of renewing it again. According to China's Commerce Ministry, this decision traces back to trade talks the two countries held in Madrid last year, where Washington reportedly made commitments on Hong Kong-related issues in exchange for concessions from Beijing. The timing also lines up with something bigger. 2 months ago, Trump traveled to Beijing and met face-to-face with Xi Jinping at a state dinner. Since then, there have been small but noticeable signals of a thaw. Earlier this month, a pastor who had been detained in China since last October was released, reportedly after Trump personally raised the case with Xi. Xi is also expected to visit the United States later this year, which would be a major symbolic moment on its own. So what's actually at stake with Hong Kong's trade status? Before 2020, Hong Kong operated under what's called separate customs treatment. That meant it could import certain sensitive technologies, negotiate its own trade terms, and generally operate under different rules than mainland China, treated by Washington almost like an independent economic actor. Once the 2020 order stripped that away, Hong Kong lost a lot of the finance and trade advantages that had made it such an attractive bridge between China and the rest of the world for decades. If the U.S. actually lets the current restriction expire, Hong Kong could start recovering some of that role as a genuinely distinct gateway for international capital. Now here's where we stay neutral, because both governments have very different reasons for wanting this. From Washington's side, this looks like a goodwill gesture, something that could smooth the path toward a broader trade understanding with Beijing and set a friendlier tone ahead of Xi's visit. From Beijing's side, restoring Hong Kong's status is framed as simple fairness, a return to normal relations after years of what China has called unjustified punishment. Neither framing is wrong exactly, they're just two different lenses on the same event, and that's usually how great power diplomacy works. Let's talk about why this actually matters beyond the diplomatic optics. Hong Kong has spent the last several years losing ground as a financial center. International banks, especially American ones, have been gradually shifting more of their regional operations towards Singapore, partly because of the uncertainty created by exactly this kind of trade restriction. If the U.S. formally restores more favorable treatment, it could slow or even partially reverse that trend, since global firms generally prefer predictability over ambiguity when deciding where to park capital and staff. There's also a supply chain angle worth mentioning. Hong Kong has historically functioned as a re-export hub. Goods and components flow through its port on their way between mainland factories and international markets. Tighter trade restrictions over the past few years pushed some of that traffic elsewhere, adding cost and friction for companies that relied on Hong Kong's efficiency. A genuine normalization could quietly lower some of those logistics costs across sectors that most people never think about, semiconductors, electronics components, and specialty chemicals among them. And then there's the bigger picture for global markets. Trade tensions between the world's two largest economies have been one of the biggest sources of uncertainty for investors over the past several years, showing up in everything from currency swings to shifts in where multinational companies choose to build factories. Any sign of a genuine thaw, even a narrow technical one like this Hong Kong decision, tends to get read by markets as a broader signal about the direction of the U.S.-China relationship. It doesn't fix everything overnight, but it does shift the tone, and tone matters when companies are making long-term investment decisions worth billions of dollars. Of course, a signal isn't the same as a done deal. China's own statement was careful to say the U.S. has confirmed it won't renew the order, not that everything is formally finalized and locked in. Diplomatic gestures like this can still stall, get renegotiated, or collide with some other unrelated flashpoint before they're actually completed. Given how unpredictable U.S.-China relations have been over the past decade, caution here is reasonable, not cynical. It's also worth remembering that Hong Kong itself has very little control over any of this. Its economic future is essentially being decided in negotiating rooms in Washington and Beijing, not in Hong Kong's own government offices. That's been the reality for years now, But this latest development is a reminder of just how much a single city's financial standing can hinge on decisions made thousands of miles away, in conversations most of its residents will never be part of. So where does this leave us? A quiet trade decision, wrapped in cautious diplomatic language, that could end up mattering more for the global economy than a lot of louder headlines this week. Whether you see it as genuine reconciliation or simply strategic timing ahead of Xi's visit probably depends on how you already view the broader US-China relationship, and that's a conversation worth having in the comments, not something I'm going to settle for you here. If you found this useful, follow for more of these quick international breakdowns, no spin, just what's actually happening and why it matters to your world. See you in the next one.